Hello, traders. So much like the MARA, M-A-R-A trade that I shared with you not too long ago, I have a similar trade that I actually meant to share. And I know it's easy to say that, so forgive me on that one. Back around that same time on January 3rd, an SPX trade. But regardless, if you're in this situation, which many people may be right now, to where you have a trade that is nicely profitable, a vertical. In this case, this is a long call vertical where I bought the 47.10, sold the 47.35. At the time, our market was trading down around 4,700, and my premise was that the market would in fact be rallying up from that point. That was kind of a resistance area, if you'll recall. If we look at that on a chart, we can see that, right in this general area. Actually, I believe it was all the way back, let's see, it was on this day right here, is when I opened that trade. Actually, it was on the 3rd. So anyhow, I bought a bullish call spread with the expectation that the market might run back up here to around the 4,800 range. And in fact, that's what our market's done. It's not quite at 4,800, but it's here at 4,780. This position is up 50%, up $675. I had $1,400 in risk in that trade when I put it on. So if I back off the expiration to current, we can see that I'm up, roughly the $600-700 in this trade. So that's my current position. Now, I can do a couple of things with this. This is a nice thing about trading options, lagging into trades specifically, or making adjustments. I could leave this set just right where it is. I could first just take it off, lock in the 50%. Or I could go ahead and let it set, and then as time continues to decay, I could pick up a little more profitability in this trade to where it would get up to about $1,100 in profitability. So we can see our max profit shows up right here. Or I could do something to reduce my downside risk a little bit. You can see I have all this downside risk if the market were to pull back significantly. But in options, there's always a trade-off. What am I willing to trade off to A, reduce my downside risk, and B, in this case, add a little more juice into this trade? Well, what I'm personally willing to trade off is when I look at the market environment and we're bumping our head again on this 4,800 area, where if we go back almost 2 years ago, that was the high prior to COVID, was 4,800. So we bumped our head on it here, we pulled back, we're bumping our head on it again. We may blow through it. We're still making higher highs, so we are in an uptrend right here. So we could potentially blow through that. But my expectation is either some sideways chop or possibly pullback. Okay, so if that is my premise, if that's what I'm thinking might happen, I would be okay with placing some additional risk on the upside. So what I'm going to do is go out to a point in time. Right now, I've got it at 48.10 here, and I'm going to sell a short call. So let me include that. And then I'm also, because I don't want unlimited risk to the upside, although that provides a lot of additional juice into this trade. If I, and I do this personally, but if I was a trader in maybe larger size and I was okay taking an uncapped risk, thinking that, the market can collapse overnight via, bad news, COVID, etc. But most of the good news, in my opinion, is baked into the market at this point. So I don't necessarily personally believe that the market would explode to the upside. All that said, I like to focus on defined risk trades. I like to focus on having both sides covered, and I know exactly what my risk is going to be to the upside, to the downside. So if that's my goal here, then I want to buy a long call However, I can come in and kind of position both of these. Again, this is the awesome thing about OptionStrat. Somebody had posted a question a while back on one of the trades I did, and they said, well, what happens if volatility were to go up on that trade? Well, this is what you need to learn and understand is somebody, quite frankly, shouldn't be asking me that question. They should be going into their OptionStrat platform and bumping up the volatility and seeing how that impacts their trade, or dropping the volatility, seeing how that impacts their trade. So again, that's one of the cool things here, and that's basically what modeling is all about. So that was just a little sidetrack, a little deviation there. But again, I can come in, I can put on a vertical, in this case, I'm selling a call spread. Selling that call spread, let me just take these back out of here a second. And so right now, my max again is 11.10 in profit, and the market can rip up as far as it wants, and I'm going to have that 11.10. But if I'm willing to take on some upside risk, I can go ahead and put on that vertical spread, and rather than having a max profit of 11.10, my max profit now goes up to about 1,600. So I'm picking up, in this case, another $500 in theta decay that can happen. Not only that, but I'm also reducing my downside risk. You can see previously my downside risk was about $1,400. Now my downside risk is in the $900 range. So by selling this extra spread up here and bringing in an additional $500, I've basically lowered the cost basis in my trade. Now, I did take on upside risk. So now if the market were to rip up here to 48.50 and we were to decay up in this area, well, I'm only going to come out of this trade with maybe $100 in profit. Okay, so I would be giving back the profit that I've currently built up in this trade if that scenario were to happen, if the market ripped all the way up to here and I didn't do anything to adjust it in the meantime. But I don't really look at things that way. I look at this as though, okay, if the market were to rip up, even if the market, if I fell asleep, the market ripped up 200 points, well, okay, I would be down from where I'm currently at, but this trade would still not be a loss based on the way I'm selling this spread right here. If I had a stronger belief that the market's not going to go much higher, well, geez, I could make that spread much higher. In fact, I can make this spread so large and pick up so much additional money here that I now no longer have even downside risk in this trade. So again, I can come in, model this, define it however it is that I want to define it, and make the adjustment. Now, one of the things that I will often look at here is I want to look at my Greeks. So if I come here right now, not only have I increased my theta significantly, so let me just back these off again. So my theta is 18 right now. By putting this spread in there, my theta jumped considerably. Before I do that, though, let's also look at the delta. Right now I am positive delta, meaning that the market has to go up in order for this trade to continue to make profit. Go up or time has to decay, one of those two things. Now, if I feel like I don't know that we're going to go much higher, I may want to neutralize that delta. And again, I can do that by selling this spread. So when I do that, again, I can adjust this around, but right now it's actually slightly negative delta to where this trade would actually improve in profitability with a little bit of pullback in the market. But again, I'm not really necessarily concerned about making it negative delta, but I've taken out the bullishness of this trade because I personally am making the assumption that the bullish nature of our market is going to subside in the near future. That's just my premise, not saying, of course, that's correct. And of course, I can adjust the bullish nature of this by maybe I want a smaller spread up here. Now, that doesn't bring in as many dollars. It doesn't bring in as much theta, but it does keep me a little bullish if my premise is more to the bullish side. But I'm okay being pretty darn neutral here in this particular case. So I'm going to do something like this right here and basically turn this into a broken wing condor. Let's see, I wanted to keep this. I didn't necessarily want risk of loss on the upside because we are so bullish. So probably there, I'll pull that back to 48.25. So this will be what I'm going to do here. And this is pretty much delta neutral at this point. It's not even 1 point in delta. So this is going to be pretty much delta neutral. So what I'm looking to have happen now is the market just decay out from under me between 48.10 and 47.40, somewhere in that general range. And if that market continues to decay there, this will continue to build profitability into this trade. So that's my goal or objective. I'm going to come in. I'm going to save this trade. So this is, and I found this trade, if you recall, through bullish flow sentiment back on the 3rd. I say that, but again, I did this video. I quite frankly blinked on posting it. And I apologize for that. Had a lot of family and stuff in for the holidays and just blanked. But anyhow, I'm going to go ahead and make a note here that I am adding a short call spread to neutralize delta and increase theta. And I call a move like this juicing the trade. Okay, that's just kind of, it's like I can extract additional dollars out of the trade if my premise remains the same, or if my premise holds true, if my premise bears out. So I'm going to go ahead and save this, and I will copy this link. I'll put it in the description down below for everyone. And as always, please give me any comments, ask questions, etc. Love to help out anywhere I can. Take care.